Good morning and welcome to the Daily Energy Markets podcast. The season kicks off 2024-2025. It is the 1st of September. And as luck would have it, the 1st of September also aligns with being the first Sunday of the month, which brings back the mighty Mike Muller and Christoph Ruhl, dragged out of their summer holidays, kicking and screaming into the new season. But welcome, guys. Love to see you. I hope all is well.
Yeah.
Yes, sir, it is.
Mike, let's kick off with you. Mike Muller, of course, head of Vitol in Asia. I'm sure he'll be rushing back there in the next few days to get in time for APEC, which is only a few days away now. Mike, since we broke away 2 months ago for the summer holidays, it felt and it seemed, and it was, $80 Brent was a floor of this oil market in 2024. In our absence, it feels that we come back and now it is a ceiling. Your thoughts on that and what has changed in the 2 months that we've been away at the beach?
Well, speak for yourself here, Sean. But yes, hello from the UK. I'm here for some days of business before APEC starts this time next week, indeed. Yeah, I mean, that pie chart, that poll you just showed of your audience showing consensus around 80, 85, 90, 95 does indeed look high now. But I think it's going quite far to say 80 is now a ceiling. I mean, we spent much of last week at or around the 80 mark and had a slightly weaker close on the Friday. But bear in mind, of course, Friday was expiry, so don't look too much at the front month. That is not really representative because the expiring contract tends to be a function of the moving average of the final day. For oil markets, look at the backwardation. There is still a very, very strong signal from the markets that demand at the very front end for crude oil is strong, and I emphasize for crude oil. So you now look at the front spread for Brent, looking at the November-December spread, because as of tomorrow, Monday, September 2nd, front month contract is no longer October, it is November. You've got 75 cents backwardation, and the month beyond, you've got 55 cents backwardation. And in WTI, the backwardation is even steeper. You have 70, 80, and at the front, at sometimes 90 cents backwardation. The markets are less strong in refined products. And of course, that is generally your leading indicator. That's where the demand actually occurs. And you've got quite interesting situation where for refined products, you don't have that same degree of backwardation. In some cases, you have contango. So mixed messages there. But the front of the crude oil market, which is where supply can at times be managed by OPEC Plus, is still at this time healthy. But I think it would be going too far to say it is as strong as when you showed that poll, that pie chart, where the consensus ranged from 80 up to $95. And indeed, one of the larger advisory investment banks revised their outlook for the balance of this year from a range that they had at 75 to 90 range to now 70 to 85 range. So I think people are guided by that, and whether the market will go all the way down to 70 remains to be seen, because there are good reasons at the front end of the market why supply remains tight. First and foremost, of course, the disruptions of supply in Libya, which have been front of mind for the past 2 weeks, with outages towards the end of last week reaching levels that are of concern. But if you have poor product markets and strong crude markets, and crude gets stronger and people continue to be concerned about demand in places like China at the front, you end up with refining margins getting compressed. And that has led some people to making statements that they're looking to trim refining margins, so to trim runs. And in such a scenario, if prompt oil goes missing from somewhere like Libya, markets are less concerned about rearranging their schedules. They simply run down inventory and then plan to run a little slower in future on the margin where there may be no margin. So that's the brave face that the refining industry is going to put on any outages and any absence of supply from a source such as Libya. All the while, of course, yes, go on.
Yeah, I was just going to bring in Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Christoph, welcome back. The other thing that's changed in our 2 months away is that the Fed has finally sort of acknowledged in public that it's time to start cutting rates. Your thoughts on the change since we were last here, that being one of them. What do you point to else other than that, and what its significance? Your thoughts, Christoph?
On the oil price, I think that it's of course, it's a bit of a fool's game to always come with these point forecasts to say 80, 81, 82. What we have observed, or I think what we do observe, is a shift in expectations, and therefore the trend which has been with us for the last 3, 4, 5 months, which was indeed some 85 and then driven ups and downs by mostly by Gaza, to be frank, by geopolitical events, is now a trend which points downward, with everybody expecting probably starting the fourth quarter, but for sure in the first quarter 2025 to be a supply overhang, rightly or wrongly. It's not just one investment bank, it's Goldman, Citi, it's basically almost, except Standard Oil, probably Standard Chartered, probably everyone I looked at who downgraded the medium-term forecast for next year. And these expectations now are looking for a new sort of level around which geopolitical events and disruptions can let the oil price bounce. It's true about the backwardation, which Mike mentioned, and for me, this has a lot to do also with the upcoming uncertainties, in particular the hurricane season. I think a lot of people are waiting for this year to be a bad hurricane season again. And that plus the Middle East uncertainties will then determine the fluctuations around a trend which points more towards 70 than towards 80, I would say, driven by these expectations of a supply overhang. The Fed decision on that end is of course good news for the economy, and it looks increasingly like a soft landing in the US, and what we have said here many times, stabilization of the situation in China. That would actually be arguments for keeping that trend in oil prices a bit higher than would have been if there would have been no decline in interest rates, or if there would have been a recession scenario. So the more it points towards a soft landing, the stronger economic growth is expected to be, the better for the oil price forecast, and therefore the better for the medium-term trend which we are observing. But I think we should, for looking for a trend which doesn't return between 80 and 85, if there is no external disturbance, but which will be more closely to 70, 75, and then bouncing around it again, driven by all sorts of temporary events.
Mike, the other thing that seemed to change, or at least coalesce from the point of view of going into the summer holidays, the diversion of views on the global oil demand growth for 2024. There was ranges, but generally ranges that were more 1.5 to 2 in terms of obviously OPEC at the top end. But we sort of come through the summer with a consensus being more around 1 now on the lower end of the sort of general views going into the summer. Rystad Energy held a session last week where they pointed that the global demand growth only being around 1 million barrels a day for 2024. That to me sounds like $80 is a ceiling, not a floor.
Yes, but not entirely correct with those numbers. It is true that over the summer, just about everyone has revised downwards their demand projections for full year 24 and of course 25 on 24 demand growth year on year, to a point where the growth numbers in demand more or less match supply of non-OPEC crude growth as well, handing the challenge to OPEC Plus to manage the balance in that context, meaning there's a perception that there's going to be less room for OPEC to grow production, to put production back on the market again, as at some point a few months ago people thought was absolutely going to be necessary. So what was a rather bullish outlook for crude in the back half of this year, which we are seeing in crude, helped of course by the Libya story and things like that, has become a softer general outlook, that's for certain. But no, the demand has not been revised from 1.5 to 2 down to 1.0. That would be a 500 to 1 million barrel day demand downward revision for calendar year 2024, which is more than half elapsed. Impossible, right? What I think we need to distinguish is that there are 2 sets of numbers that you need to look at. One is total hydrocarbon growth in demand, and the other one is demand for a refined product. The difference being NGLs, gas liquids that come from gas production, which has become an increasingly large segment of total supply into petrochemicals, often a completely forgotten segment of trade, right? So the 1 million barrel day figures, in my mind, most likely exclude NGLs. But they do form part of the supply chain because they do go into petrochemicals and also into gasoline blending at times. So I think the movement in the movement in demand projections from July to now is probably down a couple of 100,000 barrels a day at most. Yes, in most people's balances. That's still very, very significant. That really is quite a lot, because that's, just call it roughly 3 VLCCs a month of less demand from the Middle East Gulf to places like China. And of course, fingers are pointing at China as being the place where most of the downward revision has occurred. The industrial statistics from China are not shabby, but they've not been encouraging either. And if you look at various indices around China, it's not just oil and energy. There is little reason for hope that those will revive. People point a lot to electrification, substitution of diesel demand with LNG for trucking, and also lower industrial demand in general. And if you put all those together, you then add to it the very latest signal from China, where the official export quotas for refined products for the balance of this year came in at a lower level than were expected, tells you that China intends to run its refineries a little less hard. So that's taken the wind out of the sails of the market somewhat and countered the shortage of Libyan crude.
Christoph, I wanted to just drill down a little bit into this idea of the soft landing, because I'm really struggling to understand why we're cutting rates, why the Fed would be cutting rates. The US economy is growing at 3%. They're near full employment. The stock market's roaring to new highs every time I open my computer. Why is there a rate cutting cycle beginning, which I know we're into sort of new frontiers of monetary policy in the last few years, but why are we cutting rates? I know in Europe it's very sluggish growth, it's barely got a heartbeat, but the US is thumping along.
Before I come to that, let me just say 2 additional points to the adjustments in demand. So I don't know how much the adjustment was in the individual cases, but I would hope that they would adjust within the same framework. So either they include NGLs or they just focus on crude. What matters more there, I think, is the enormous spread which we still have. We still have OPEC projections of demand for this year, which has 3 months left, more than 1 million higher than the IEA's projection. And there we will have to look carefully on the climb down and how it is when it occurs. And the second is always this, every analyst, who wants to justify joining the herd of lower demand projection points at China. And China is such an uncertain environment, and China is so dependent now from Russian oil imports, about which we really know very little in terms of numbers, that I would just add some grain of caution, and the demand figures may not be as bad. I would just look more at the economy in China than at the oil demand numbers published. So on your question, why do we need a rate cut? Some of us might probably say we don't, but the Fed has a dual mandate. The Fed has to do 2 things. It has to keep inflation in check, which has now been defined as keeping it at a level of 2%. And it has to make sure that it has to take care of high employment levels. And that's the tension in which they live. And you may have heard this very old saying that, I forgot the numbers again, 9 out of the last 5 recessions have been caused by the Fed, or have been predicted by the Fed and caused by. What happens here is a tension where people are afraid that monetary policy, interest rate policy operates with very long lags. And so you may not lower your interest rates, and your employment looks good as it currently does, and the economic growth figures look good in the US as they currently do. But underneath, trouble is brewing, credit is being curtailed, leverage is being driven back. And before you know it, the economy tilts into a recession, and then it is not only too late, it's never really too late, but you have to make much bigger adjustments to get it out of a recession, and you have much more volatility than anybody could want. And so this looking forward and trying to hit the right target, that's the art of central banking, and that's why it's called an art and not a science. And in that context, everything else equal, it's always better for an economy to operate with low costs and therefore with low interest rates. So in that context, they try to minimize interest rates, to minimize the costs to the economy, and to adjusting the economy so that both inflation and employment are served equally well, knowing that whatever they do will become visible in the data, sometimes 2, 3, sometimes probably more months down the road.
And gold hitting records now on this sort of, obviously gold's been on a climb this year, but continues to have momentum with this announcement that the Fed is going to cut, indicates at least some signs that the market's telling us that inflation is going to be bedding in here, that that essentially the Fed is not slayed inflation, and gold is telling us that. Your thoughts on that?
I think, first of all, gold is telling us that we enter an age of even greater uncertainty. We have the elections in the US. We have the uncertainty which you mentioned about inflation. And there you could argue the higher inflation, the higher the temptation to hold gold. But you can also say the lower interest rates, the lower the opportunity costs for holding, and therefore the higher the temptation to hold gold. So that balances a little bit. I think gold benefits now from a, no pun intended, Goldilocks scenario in terms of geopolitical uncertainties, in terms of the China-US conflict, in terms of what happens with China, Russia, and Ukraine, this triangle and the US involvement, and looming above all the uncertainty of the US election, which will impact all these things. And so it makes sense for a lot of people to hedge their assets with holding golds, and probably for even more people or financial institutions to anticipate that and to sit a little bit on gold while prices go up.
Mike, the other big development looking forward now as we look to the month ahead is obviously OPEC, the 8 countries within OPEC that have announced they're going to start increasing production from October 1st, which now is 1 month away. And I'm wondering, just from a start point on that conversation, has the market bedded in that as happening, or has the market bedded in that they're going to abandon that?
Yes, I think that is indeed the big debate, and it's going to play out over the coming weeks and in the week coming into APEC. I mean, this is the time of year where, for many, not for India, because India's cycle runs April to March, but for most others, you sign up for long-term committed crude, including term contracts from OPEC suppliers, and you take a view of your relative economics and your outlook for refining margins, and the official selling prices that are going to be announced in the coming days, probably the back end of this coming week, for Asian refiners in particular, are going to serve as a guide as to whether that policy is one of supply going missing or supply to market being increased. Yes, all eyes are going to be on those official selling prices, and then on the acceptances of nominations for the forthcoming operational month, which is October. Of course, Asia's already trading November barrels. So I'll give you the diplomatic answer. I mean, the market should be reflecting what's been announced, with an overlay of messaging of those people that are close to decision makers in OPEC Plus and Saudi in particular, in terms of what the hints are that are forthcoming. There is a school of thought that there is less room to put supply on the market than there was before, and I think we'll see that playing out if we see lower prices, or if we see a disappearance of backwardation. But as I said at the very start, the front end of the crude oil market remains quite snug, quite healthy.
I mean, Mike, just to follow up on that, just technically at this point, I mean, 1 month out from increases starting, that's kind of the ship sailed on that, at least for the first month, 180,000 barrels. This is a month-to-month increase, as was announced earlier this year in great detail. At least that first month can't be turned off now, surely.
Indeed, and that's why you're also seeing a lot of talk about those countries that had somewhat overproduced, reining in that overproduction. There's been a lot of mention of Iraq of late, Kazakhstan, and various others. So that rebalancing is also occurring behind the scenes, and we're not getting any official statements on it, but there's a lot of talk about production being corrected in order to rectify the balances there also. I think we might end up somewhere in the middle. It's very difficult to say, but the proof's in the pudding when you see the acceptances of nominations, which is not a publicly available set of information, but you'll get feedback from major swing refiners in Asia, be it the Chinese, the Koreans, some of whom have been talking about wishing to cut runs. They may just nominate a little bit less in October, and therefore there may be no need for OPEC to send a message. They may just, the major producers may just supply a little bit less than they had intended to, and that figure you mentioned may not come to market in its entirety.
Christoph, just looking at the sort of macro health of some of the major actors here, obviously Saudi Arabia at the center of it. The sort of other thing that happened over the summer was the Saudis announcing a sort of officially sort of a significant step back for some of the very ambitious Vision 2030 spending on these giga projects, hundreds of billions of dollars, fiscally a little bit more stressed in the kingdom. Your thoughts on where that outlook intersects with where their decisions are in the oil markets, and similarly, where does Russia come into that conversation, and what does it look like in its ability to comply with all of this?
When you look at the major oil producers, you could certainly sign off on what Mike has said, that they tend to produce too much and not too little, and even more certainly that they have an increasing desire to not cut their volumes overly. They may not, in these circumstances, be able to control the smaller ones who will then go ahead with the pre-announced cuts. That would be my assumption. We don't see anything being taken off the table as long as Russia and Saudi Arabia so in the situation in which they are in. What we are seeing, you're right, in Saudi Arabia is some adjustments necessary for fiscal reasons. But never forget that Saudi Arabia, for many, the majority of years in the past, has run fiscal deficits without a blink and without a problem, and always managed at the end of the day to balance them through the oil price cycle. And also, when you talk about 2030, what to me, as an economist, is probably much more important are those components of 2030 which were addressing market reforms, economic reforms, educational reforms, even fiscal liberty, on which they are at least as much behind as on the big infrastructure projects. And one should look at those too and sort of help supporting the forces for change here. Back to oil production, we have a clear situation with Saudi Arabia bearing costs for keeping the line and keeping prices up, with the UAE being the country with the highest cuts in percentage term measured on their own production potential, because they have increased their production potential so much, and therefore behind the scenes, I would guess, continuing to push for a higher quota. And with Russia,
it would seem to me very unlikely that they'd be willing to step back from this gateway to increase, which they've been pitching for some time.
Only with a clear goal and with a clear target in mind. And at the moment, OPEC cannot claim, OPEC Plus, that they have such a clear target, because every cut means a loss in market share, and non-OPEC output is so strong, non-OPEC Plus output, is so strong that it easily abandons that. We're getting very close to a situation, even though demand is still growing, which we will find once we have demand plateaus or demand peaks in a shrinking market, where you cannot go ahead with the old game and simply cut, and the prices will go up, and rising markets, rising demand will compensate your volume cuts over time. This will be a situation where, in order to keep their volumes constant, they have to increase their market share. And that means they will have engaged in price competition. But coming back to today, the last big player here, Russia, is also increasingly they still have enough revenues, but they're getting in more and more dire straits in terms of their economic performance has deteriorated. And Russia is always the country where these things sort of move below the surface and suddenly it cracks to everybody's surprise. And to me, over the last few months, when I look at the economy, it is suffering from more troubles than it has for some time. And even sort of the geopolitical relationships with China, the energy relationship seems to be more fraught and more difficult than it used to be, when I think about the missing pipeline permits, the missing gas outlet for gas exports. And you could say the same for Ukraine, where the political moves become increasingly sort of uncoordinated and almost a bit desperate. But something there is brewing, and in that situation, Russia will not be in a mood to effectively and in real terms cut production when they need every penny.
Mike, just looking forward into the fourth quarter now, as we go into this sort of post-summer phase of the year, the fourth quarter cycle, what comes with that? I mean, typically a lot of ramping up of products for the winter and so forth. What kind of a demand push does that give us, or not?
You get the typical seasonal upswing in Asia, less so in the West. In fact, the opposite in the West, where there's stronger demand and therefore there should be strong refining runs. But it's all a question of inventories and margins. And as I said before, margins are teetering at the point where they've just about evaded real run cut territory so far. Held up, by the way, by reasonably buoyant outlook in the petrochemical side of things, and also a slight bounce in the fuel oil, in the VLSFO in particular. But yes, Asia tends to pull, so you'll get Japanese refiners who've had a big spate of refinery upsets this year, nominating more crude to run to satisfy demand in that time of year. And on the inventory side, I guess you're also looking at how much discretionary diesel has been burned to cope with some of these ridiculous heat waves that we've seen. I mean, Sichuan province, 2 weeks solid at 40 degrees plus. Shanghai had a 10-day streak of around 40-degree temperatures. And if you translate that into less efficient energy supply chain markets around Asia, you've seen a lot of diesel burnt in gensets just to keep air conditioning on and things like that. So then you've had probably the heaviest jet fuel demand season in a very long time, possibly ever, in terms of summer holiday consumption. That's more of a Western Hemisphere thing. So the market has had some pockets of decent health. But I'd come back to chemicals. I mean, in per ton terms, naphtha is obviously a lighter product, 9 barrel ton factor versus diesel at 7.5 barrel ton factor. But naphtha has been a laggard of late. But I think you'll find that in China now, naphtha is pricing at a level that is at or above diesel. And that's something that's unthinkable in international markets. But it tells you that there is strength of demand in the petrochemical sector, and people are going as far as to say, how do we get to higher naphtha yields to make more petrochemicals in China, when that's not on anybody else's radar just yet.
Mike, just to follow up on that, I mean, clearly we're getting to the end of the year. China's had obviously a sluggish along year, sort of with some expectation that, they'll finally get the bazooka stimulus going, or they'll turn the corner on this thing, or do you expect any of those things still to happen this year, or are we just sort of sluggish along, all more or less okay, but no real game-changing moments?
I think on China specifically, there's been a disappointment on foreign direct investment, and the government's made up for that with quite a substantive stimulus package to counter that. And what's happened in the past is Q4 has always been the most interesting month in terms of Chinese policy. So we did see 2 years ago at this time, or a bit later in the year, a surprise addition of export quotas, which had the Chinese refining system running harder, and then taking some of the supply of prompt Russia, for example, off the market at that particular time. And that was to stimulate, but also margins were positive, and there was some sense that it was to do with hitting some GDP targets as well. So China can surprise on that front. The other market that's pretty strong, stronger than one would have expected when you ended this series in July, was the LNG market. We've seen a number of outages, and what's been relatively robust demand manifest itself in South Asian countries that are price sensitive, tendering to purchase LNG at prices that 5-6 months ago we would have said they can't afford. So that's also a relatively positive signal, which might do away with displacement of diesel demand into LNG, or on ships, fuel demand moving to LNG for bunkering, as LNG prices remain high, should oil prices fade a little from here. And then, of course, you still have, we must remind ourselves, the burning ship in the Gulf of Aden off Hodeidah, which the Houthis now are apparently trying to salvage. But I think they lost quite a few friends in the, let's call it, outrage over Gaza world, over that incident where they went and quite deliberately planted mines on a ship after the crew had dropped anchor and abandoned the blazing ship, in order to that's not what people expect people to do in solidarity with the situation in Gaza.
Yeah, it is a very strange circumstance where they're now the ones looking to salvage the ship. Let's wrap up, Chris. Sorry, go ahead.
What I was trying to make is that in many people's minds, that image has a lot more people than before not wishing to transit that particular passage. So it leaves more oil and water, and it serves to support markets if oil has to travel further distances, right?
Yeah.
Sorry.
Christoph, the other big sort of geopolitical flashpoint, of course, is Ukraine. And the other big development over the summer is the Ukraine invasion into Russia, and what kind of a moment that is. And now it seems that has kind of clearly scaled things up inside Russia, but Russia's retaliation seems to be scaling up, Ukraine requesting more permissions for more long-range weaponry to go into Russia. Your thoughts of where that may go? What seemed to have kind of settled into a horrible scenario, but status quo is now seeming to find a new level of engagement. Your thoughts on that as a possible factor for the markets going forward into the fourth quarter?
I mean, from the little I understand from the military situation was that despite its steady advances in the Donetsk region before the Kursk invasion of Ukraine, Russia had such tremendous losses, and the pace was so slow, and Ukraine had managed sort of to stabilize its recruitment system a little bit, that things were actually looking, even though the grinding slow advance of Russia were looking not very good for Russia on the military front, and especially in terms of cost of human lives, which were so tremendous that at some point they will backfire. Now what has happened, the invasion into Kursk, Zelensky's firing of the airport chief because of pilot crashes, the super secret 3-point plan, which he talks about telling Biden about, but nobody else in the world. This looks like signs of desperation and signs of disorganization more in the Ukrainian government. And Putin, obviously, or his generals did not fall for the bait. They did not suddenly shift troops into the Kursk region and lessen their grip on Donetsk. It seems, militarily speaking, again, from the little I understand, just the opposite has happened. The Ukraine has transferred thousands of experienced soldiers from that region into Kursk, into Russia. And Russia has kept its troop on the place and could therefore accelerate its pace towards that city, that strategic city, Proletarsky, which is the battle is concentrating on at the moment. So this suddenly looks like a little bit of respite to Russia. And if there is no unknown reason for doing the Kursk thing, which just hasn't surfaced in public, then it was a miscalculation in my view, and one which is easy to understand because every Russian will be, of course, upset, about somebody else first time after Second World War invading the country. So Putin could afford not to react immediately by throwing all his best troops away from the Ukraine territory into the defense of the fatherland. He could wait because people are outraged anyway, and it's just small in the big picture of things. It's a little slice of land which he can clear up any time after he has finished his Donetsk business, and that's exactly what he did. And it, militarily speaking, seems to turn into a disadvantage for Ukraine, unfortunately. This brings us closer.
You're in Germany today. There's elections in Germany today. Is there a continued support for this Ukrainian position, funding? There's been some noise by German politicians over the summer to start to signal a kind of a defunding situation.
I think among mainstream politicians, there's still a consolidated, firm view that the support needs to be continued. Then there are an increasing getting a bit stronger people on the fringes who never would like to touch Russia or will now swing towards saying we can't afford it, we don't have the money and so on. But that's still a minority position. It is unevenly distributed. So what you will see in the elections this weekend will be a strengthening of the, so to speak, pro-Russia fraction of the people who would like to stay away from that or stop supporting Ukraine. And of course, as always in these things, the less successful militarily Ukraine is, the louder the voices who would say, oh, this is just wasted money, let's stop it.
Well, we're going to have to wrap it up there. We're 1st of September, Brent struggling to get out of the 70s. And I think a lot of the discussion as Mike and the whole sector moves to Singapore next week for APEC, will $80 be a floor or a ceiling in through the fourth quarter? It mightn't make much difference to the average for the year, which looks firmly at a kind of $81, $82 level. But is this a market now with a ceiling of 80? That's the question. Mike Muller, head of Vitol in Asia, thank you so much for joining us from London. Have a safe trip back to Singapore. And of course, Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy at Columbia University. Thanks, Christoph. Good to see you. Hope to see you both in Fujairah and in the UAE not too long away from now. But until then, thank you so much. All the best.
Take care.
Thank you. Bye.
Cheers, guys.